Welcome everybody. Hello again. Just a quick check. Can you guys hear me okay today? Before we start off the session today. Okay, yeah, Alexi is back. Okay. What we're going to do today is that we will divide this session into investment appraisal, focusing on foreign project, okay, foreign investment appraisal, and also we'll move on slowly to Black-Scholes option valuation in terms of rail option. There's one question I would like to do today, which is going to be dealing with option together with what do you call this, investment international project appraisal. Now, this question is a 50-mark question. If I'm not mistaken, appeared in the December 2013. Okay, it's a very nice question. It has got broken down into a few parts. Now, part A is purely textbook answer. Is that okay? Discuss the role of World Trade Organization and the possible benefits and drawbacks to Megan of reducing protectionist measures. Now there's 9 marks here. There's 9 marks here. So if you're going to break it down, so there's discuss the role, that's going to be the first part. Benefits, that's going to be the second part. Drawbacks, that's going to be the third part. So there's, if you break it up, I think fairly distributed to 3 marks each. Role 3 marks, benefit 3, drawbacks 3. So I think this should be no problem for you guys. I'll just go through that one. I'm not going to write any answers for that one. You can always refer to the suggested answers published by the ACCA. Part B is going to be another evaluative report for the board of directors of Kiomura, which addresses the following parts and recommendation. Just like make it bigger. Okay, if you're using phone, I think. Okay. 85. Okay. An estimate of the value of the project before considering the Balut's offer. Show all relevant calculation. Now this is going to be 14 marks. An estimate of the value of the project taking into account the Balut's offer. This is before and after taking into account Balut's offer. Show all relevant calculation. Again, 9 marks. Now this is going to go to Appendix 1. This is going to go to Appendix 2. Yeah, Appendix 1 and Appendix 2. And number 3 here is going to be a discussion of the assumptions. That's normal, that's common. You're going to see a lot of assumptions in these September exams. Not a lot. I mean, there'll be one part. I think it should be there. Okay, assumptions. In this case, assumptions of investment appraisal, the first part, and assumptions of, this is going to be Balut's offer. Is let me fast forward and tell you, this is actually a put option valuation that we're going to do. Balut is offering to take over lock, stock, barrel after a certain number of years. So this is going to be, you have an option to abandon. It's going to be a valuation of a put. So what are the assumptions of the rail options for the put options? Show all relevant calculations. So sorry, not another one. Okay, and additional business risk. So if you ask me, there is 14 marks here. Assumptions, and additional business risk. Maybe assumption is going to be 5 to 6 marks. 3 marks for this assumption, 3 marks for this assumption. So it's going to be 6 marks and 8 marks probably is going to be set in for us to get from the risk of Kiomura before making your final decision. If you ask me, it's a doable paper during that particular. I still remember my students all coming laughing and coming out from the exam, though. But the only thing they said was there was no time. They were prepared. They were prepared because there was this article written by Sunil. I think everybody read that article, and there you go. And it came out exactly like what he wrote. Yeah, exactly. I mean, close to exact. I shouldn't say exact. Close. I shouldn't say close. Yeah, it's close to exact. 99.9%, except for this one. Okay. Now, professional marks will be awarded for 4 marks over here. 4 marks. I think you know how to get 4 marks. Yesterday we spoke about that, how to earn at least 3 marks. Okay, if you discipline yourself to get that 4 marks, you can you write nicely. You have a lot of headers. We'll emphasize on this again just in case some of you missed that part. Okay. Now, okay. There's a question here. I mean, Basanta is asking, is it okay to change the order of the answer? Well, you can. You can do part A last if you want to, or you can do part A first. You can do part A first, and then you can go to Q number 2 and come back to part B, no problem. But once I feel that if you want to start part B, it's good that you do this B incomplete. Don't do part 1 and then go to part C. No. Once you do B, you finish B. But B, you can do this first. That means you're writing a report first. The appendix you're going to put at the back. Okay, you can put the report. You can start writing. Some of them just start writing the report all the way. Yeah, and especially in this question, you can straight away start with the report because this is going to go to the report. This too is going to fall back behind the appendix. Yeah, I hope that answers your question. Yeah, correct. Part A you can do last. Yeah, part A you can come back and finish it off after even if you finish question 2 and question 3. You can come back and do part A, but just make sure that you just put question 1 clearly, just in case. Yeah, just in case. Okay. Now you have this long question here. Okay, now very quickly, we're just going to highlight the important areas. Since becoming independent over 20 years ago, the country MEGAM has adopted protectionist measures which have made it difficult for multinational companies to trade there. However, recently, after discussions with the WTO, it is likely MEGAM will reduce the protectionist barriers significantly. So what is the decision here? They want to relax the protectionist measure. Maybe they're protecting their local industry. Okay, that was paragraph number 1. Paragraph number 2, encouraged by this discussion, Komura, a company actually is based in America, I think. They didn't say it here. Okay, Komura, a company producing packaging foods. Okay, this is a business packaging foods, is considering a project. All this is going to be, when you're reading, you know there's some risk involved that you need to talk. Yeah, packaging food is sensitive, yeah, to regulations and all that. Considering a project, set up a manufacturing base in MEGAM to sell its goods regional countries nearby. So you're going to have currency risk already. Yeah, I understand. You're going to have a currency risk. Okay. Initial investigation. This is going to be sunk cost usually. Just mention that in the assumptions paragraph. Assume this is sunk cost. It's good to go. Established that MEGAM had appropriate manufacturing facilities, adequate transport link, reasonably skilled but cheap worker. All these are good news. Okay, skill is good news. There's not much of a risk, but it can also say risk like you need to give them enough training just to make sure they are on par. The investigation concluded that the protectionist measures were reduced. Demand potential for Komura products looks promising. It also feels that an early entry into MEGAM would give Komura an advantage over the competitors in 5 years, after which the project will cease. So this is just telling us that You have a 5 years life. You have just got 5 years life. Sunk cost, promising, looks good. Competitors will come in. Yeah, we'll have an edge against competitors only for 5 years. Yeah, what if it's going to be only for 2 years? Yeah, then you have to measure sensitivities and stuff like that. Okay, third paragraph is Megan peso is going to be 72 pesos for $1. Setting the manufacturing base in Megan will require an initial investment 2,500 million immediately to cover the cost of the land, which is going to be 1,250, and machinery 1,250. Okay, so this is the total. They break it up into half machinery. My question is, what is your TAD? Building. Okay, tax allowable depreciation is available on machine at an annual rate of 10% straight line method. Now they only have 5 years. You still go on straight line method. 1, 2, 5. Is that okay? 1, 2, 5. The balancing adjustment will be required at the end of 5 years, when it's expected that it will be sold for 500 million, which is after inflation. The market value of the land and building in 5 years is expected to be 80% of the current value. Means they parked the land somewhere in a lousy place. Okay, the building value did not go up, or the land value did not go up. It went down 80%. That's going to be your terminal value or residual value for the building. The amount is inclusive of any tax impact, so you can put this after tax. Paragraph number 4, Kimura will require 200 million working capital immediately. Immediately is T0 or year 0. It is not expected that any further injection will be required in 5 years. Now this is straightforward in terms of working capital. Students do make mistakes at this level. Whenever there's a working capital change every year, students, they're still not very clear. So make sure you practice on that type of questions. Okay. In this case, it's straightforward. Now, paragraph number 5, production and packaged foods will take place in batches and product mix. These batches will then be sold to supermarket chain, wholesalers and distributors in Megam and neighboring countries, and repackage them. All sales will be in Megam peso. Now, rule number 1 is when you go to another country, all cash flows relating to the project must be in project currency. That means everything must be in Megan peso. If it's not in Megan peso, you have to convert that into Megan peso. If you're selling in America, you got to change the dollar to Megan peso. Even if you're selling probably in another country, let's say you're selling in France and you're receiving euro, so that euro has to be changed to Megan peso. The estimated average number of batches produced and sold each year. Now, 10,000, 15,000, 30,000, 26,000, and 15,000. This is what you have here. The current selling price for each batch is estimated to be 115,200. Now, I just want to highlight to you, the examiner is very, very sometimes tricky. This is current selling price. That means if you were to sell today, you are not going to sell today, isn't it? You are not going to sell today. If you were to sell today, this is the price. Now, all these small things, you have to be careful. You don't put this in year 1. This is going to be in year 0. And the word currently means this is going to be your cost related to this currently. In addition, there will be a special packaging that Kimura will send to Megam. Currently, again, all this is going to be at 200 per batch. Training and development cost is going to be estimated to be 80% of the production and selling cost in the first year, before falling to 20% of this cost, excluding the cost of packaging in the second year, and then nil in the remaining years. It is expected that the cost relating to the production and sales of each batch will increase annually by 10%, but the selling price and special packaging will increase by 5%. All this is going to be for your cost forecasting and also your revenue forecasting. This is going to be a huge number. This is each batch is 100 over 1,000. So maybe the figures might run to millions. So maybe you want to have rounding adjustments later on. Okay, paragraph number 7. The current corporate tax in Megam is 25%. Komura pays 20. So basically, this is going to be treated like this. This is going to be Megan. This is going to be Komura. Komura pays 20. Here you pay 25. So if you pay 25, you come back. Well, if there is a double tax agreement, you don't have to pay. You don't have to pay, and you don't have a refund. Worst case scenario, if you pay 15, you come back, you need to pay another 5 on the profit that is based on the 15. Then you have to convert to local dollar currency. But in this case, I think it's going to be straightforward. I think examiner knows that this question is going to be time-boggling type of question, mind-boggling. You're going to have more time to do maybe the second part or whatever. Okay. There you go. And both tax have got a bilateral tax are payable. A bilateral tax treaty exists between the two countries where you're going to offset with each other. Paragraph number 7, the risk-adjusted cost of capital is 12%, and the RF is 4. Megan has got an inflation of 8. Country where Komura is residing is going to be 2. It assumes the inflation will not change. All will be remitted back to Komura end of the day. So this is going to be 12% is going to be the risk-adjusted dollar cash flows, because rule number 1, change all to Megan peso project, then you come back home to dollar, then you adjust whatever you need to adjust in your country, maybe like for example tax, maybe you need to adjust for profit make, intercompany transfer pricing, profit, management fee received, royalty income, all this. If there is, you need to adjust. In this question, we don't have all that complications. Okay. Then you're going to have all these figures, and then you're going to discount. This is going to be a dollar cash flow, so you need to discount using dollar cost of capital, which is 12%. Now, Komura's finance director is of the opinion that there are many uncertainties surrounding the project, and as assessed, the cash flows can be varied, and there's a standard deviation of 35%. Now, whenever in your P4, or today is known as AFM, whenever you see a standard deviation, it could be for 2 topics. Yeah, 2 topics only. One will be for black scores, and one more is going to be for value at risk. This is the only 2 reasons why they want to give you 35%. Recently, Balut have offered Komura option to sell the entire to Balut, option to sell at 28 million at the start of year 3. Now, start of year 3 is technically end of year 2. So you do the project for 2 years, then you can wash your hands to Balut. If he wants to buy, he got to pay 28 million at that point. Komura will take into the decision only that time. Today, you don't have to make the decision. You try out first. If it's a good project, you continue. If it's not a good project, you just wash your hands away and walk out with style. Okay, so part A of the question, I'm just gonna talk. What are you going to write here? We're not going to write any answers. Okay. What you're going to say here is that this is WTO. WTO is actually coming in to continue what has the GATT has been doing. The aim basically of GATT and WTO will be to reduce the barriers. Is that okay? The aim will be to reduce the barriers and also prevent any protectionist measures like tariffs. There is tariff types, non-tariff like quotas. They don't want quotas. They don't want embargo. They don't want maybe what do you call this difficult custom procedures, you know, that kind of thing. Don't make it difficult for us to come in. So these are the things that GATT and WTO has been working along all this while. And WTO also could act as a forum, yeah, negotiation, where there is a dispute between countries. Is that okay? They want to encourage free trade, basically, where one country you must offer to all the countries, not only in your own bloc, Euro bloc. Yeah, you have free trade going on, but you also should offer to everybody. Open up. Is that okay? That's their objective, ultimate objective, but they are moving towards that. Okay. And this question, Megan is in the country where they are willing to, what do you call, open up. Is that okay? They're willing to open up. Okay. So next we're going to see the benefits and drawbacks. What's the impact to Megan? Well, of course, the benefit will be all the nations will begin to like you. They'll be happy to trade with you. International trade, yeah, they'll come and buy goods from you. They like you so much now. They're supporting. Yeah, then you can also specialize now. Once you open up, you can specialize. Is that okay? You don't have to do what you are not good at. Do what you are good at. Let others do what they are good at. You do what they are good at. That will overall increase the world production. Okay. The disadvantages, you can probably say that it could harm your industry, right? It could harm your industry, especially if you still got infant industry, or if you have some industry that need protection, that it could harm that industry, or any industries that is already on the declining now, that could also harm that industry, which is going to be politically not right for politicians, because it's going to create shutdowns, it's going to create unemployment, and also when you have got this free trade, it will encourage people to start dumping, especially if you are going to be a third world country. For us, I mean, if you are going to be, if your people like cheap products, people will start dumping and can harm your local producers. So something like that, you have to write for part A. I believe you can get the full, this type of questions, if you really know the theories, you can get full 9 marks. There will be around, I would say, 10 to 15 marks. Yeah, pure textbooks, advantages, disadvantages. Just get prepared for it. Not for this chapter alone, for all other chapters. Okay. All right, now part B, estimate of the value of the project before you consider balloon offer. Okay. Wow. Okay, we'll have some questions here. Inverse code, we'll talk about that later when I do the question. Waiting for name. It's already offline already. Okay, never mind. Currency futures and options. I'll keep that tomorrow. Okay, I'll keep that tomorrow. Currency futures and options, I've lined up for it tomorrow. Today we want to concentrate on options as well as this one. We'll keep it tomorrow. Next one we have here is why mid-market rates are used in commission. We'll talk about that tomorrow. Yeah, all these are currencies. You're asking me currencies questions here. How to explain PA? Yeah, we'll teach you how to explain PA. All right, BSOP. Yeah, we are talking about MIS, correct? BSOP. Come. All right, questions are there? Answered. Okay, let's come to this answer. So what we're going to start with is going to start with part B of the question. I'm going to start with appendix or workings first. Workings. Now, in all foreign investment appraisal questions, the first thing that I think one should start, I feel my personal opinion is you should start with forecasting future exchange rates. Okay, Usually it's for a long-term project. Okay, in this case, it's going to be for a long-term project. Long-term project usually is the best way to forecast long-term foreign currency is purchasing power parity theory. For long term. For short term, then you use something called interest rate parity theory. That's forecasting forward rates and all that. Short term rates can use for interest rates theory. But for long term, it's highly advisable to use inflation related, which is purchasing power parity theory. Now, you have got a spot rate here. Very simple. We don't care whether it's direct quote or indirect quote or how is it quoted. It doesn't matter to us in this. We just want to pass this paper. Is that okay? When you go out there, then you worry about whether it's a direct quote or indirect quote. Now, Megan peso is quoted per the base is dollar. So make sure you're going to write here spot rate Megan peso per base dollar. You're going to multiply with 1 plus inflation divided by 1 plus inflation. Up must be Megan peso. That's how simple this is. And down the base must be in US. I'm not sure what country is this, but you just choose the dollar inflation rates. Very simple. Base, you put down this, you put up. How they quote, you just see this, how they quote the exchange rate and work on it. Now, what we're going to do, you can do that first, and you can start off by putting year 0. Your exchange rate is given in that paragraph 72.00. It's given exactly 72, but maybe I want to expand my answer to at least 2 decimals for today. Is that okay? Year 1, what are you going to do? You're going to do 72 multiplied by 1 point something. 1 point something. That's going to be the inflation rates. Inflation rates of Megam is found in paragraph number 8%. Kimura is 2%. So when your inflation is higher, tendency is that your currency, Megan peso, will depreciate. Okay, forecasted to depreciate. So 1.08, 1.02, you're going to get here 76.24. And you're going to move on. There's many ways of doing it. You can take 72 because the inflation is stable. You can just press your calculator, go backwards, change it to power of 2, go backward, change to power of 3 and all that. I think you know what I'm talking here. And that's it. Enough of that working. Don't show more working. Just put the final figures down there. Just multiply. You got a beautiful calculator in front of you. Just multiply by 1.08 or okay, or you can go back and change to 3. You know that scientific calculator allows you to, you know, open the bracket and go back and change and go back and change. So you're going to get here, I think worked out this one. This is just 0, 1, 2. This is going to be 3, 80.85.47, 90.50 and 95.82. So this is what you got. Okay, now, or if your inflation rates are different, maybe first year is 8% and 2%, you do like this. Second year is maybe 10% and 5%, then you multiply on your own. That means you take each year as a new year. Is that okay? Yeah, that will be the first working that everybody must do this. Just write the rates, show 1 or 2 workings there, move on fast. Okay, you cannot be sitting down there and lay the eggs. Okay, now okay, Tanzim is asking, how do you know which is the base currency? Now, if you ask me, the base is always 1 unit. Okay, the base is the 1 unit, and you don't have to care what is the base and which is not the base. If you put 72 per $1, so that's going to be the base. This is going to be the base. So you put the $1 at the bottom. Yeah, you put the dollar at the bottom and you put that Megan peso on top. So this will be Megan peso inflation. This will be dollar inflation rate. Okay, Next working I would like to show here is, I think we're going to show the revenue, we're going to show cost, we're going to show special packaging in a quick manner. You can show horizontal way, or you can show vertical way. I'm just showing you vertical way today. Okay, you can show horizontal if you want to. Sales revenue for year 1, it's simply going to be, all this must be in Megan peso, and I think the figure is going to be huge, so I'm going to put it in million. So the sales revenue will simply be your selling price, which is going to be how much? The selling price is going to be here, which is where is that? Where is your selling prices here? Okay, 1,155,200 and multiplied by the units, and it's subject to inflation of how many percent? The selling price, and special packaging has got a 5% inflation rate. Okay, good. Now, so we're going to have, just show 1 year enough, 10,000 units or batch multiplied by 1,1,200. Careful, this 1,15200 is year 0 current price, so you need to multiply by 1.05 power of 1. It's going to give you something like 1209. Well, I can put without the decimals, but then I prepared my answers with decimals, so it's going to be 1209.6. You can put 1210, go ahead. Now the second year is going to be 15,000 units. Check the units down there. Multiply by the selling price is still the same, but now your selling price have been inflated into 2 years, so it's going to be included in 2 years inflation rate. So it's going to be 1905.1, and year 3, and year 4, and year 5. You're going to continue that way. Is that okay? You're going to continue that way. I believe you can, maybe I write quick answers for you to snap a photo. Okay, this is going to be checked. You're going to have $4,008. It's going to be 3640.7, and this is going to be 2205.4. Same thing goes for your production cost, production and selling, and whatever you have here. This is also going to be Megan peso. Well, you're going to have year 1, and it's going to be 10,000 units or batches multiplied by 1 unit. It's going to be costing you, how much is that? 46,500. Okay, 46,500, and it will be inflated, but they didn't tell you here that inflation has to be how many percent is that? 10%. Is that okay? 10%. This is production. It's going to change by 10%. So multiplied by 46,500. This is already in Megan peso. I think I'm going to put in millions. Multiplied by 1.1. You're going to get power of 1. Okay. Well, that's going to give you an answer of 511.5. Year 2, you're going to do the same thing. 15,000 multiplied by this is the same, what do you call it, costing, and that one is going to be equals to 1.1 to the power of 2. That's going to give us like 8044, and you're going to get here 1856.7. 1770.1, 1123.3. This is going to be the case there. Now, basic question. Yeah. This is how it's going to be. But it will be in terms of a lot of time consuming. That's the only problem with this type of topics. So you must manage your time very well in the exam. Next one is going to be special packaging. Now, special packaging is in what currency? Special packaging is sent to Megan from Kamura, and it's $200 per batch, and the special packaging cost will increase by 5%. So they are increasing. Currently, the cost of special packaging, which means they are also selling at, excluding the cost of special packaging. So basically, they are also selling it at cost. There's no profits transferred made. It's just that I pass it to you for cost, then fine. No need to worry about when you come back home later, is there any tax on that special profits, etc. There's no profits here. It's just a special packaging. This is at cost. The only trick here is this is going to be multiplied by 10,000 unit, multiplied by 200, multiplied by 1.05, because this is a current price. So 1 year from now, it will be inflated by 5%. And the thing here is I cannot put in dollar. I have to put in Megan peso. If you want to change to Megan peso, it's going to be $72. So you need to multiply with $72. So you're going to multiply with 72. So this is year one. Am I right? Year one. Forgive me. Year one is going to be 76.24. 76.24. And you're going to get an answer here. 160.1 and so on. You're going to get here 267, 593.7, 572, 366.9. Is that okay? That's special packaging. Well, I think the others, you really want to fill up one more working. Let's do it. Training and development. According to this question, training and development will be equals to 80% of the production and selling cost, excluding the cost of special packaging. Okay, so if you look at it here, it is simply based on this figure. You take 80% of this, you take 80% of this. That's it. This is only for 2 years that you have to learn. Okay, there's only 2 years we have to learn. It's only for the first year before falling to second year, and then nil for the remaining years. 0. Nil for the remaining years. Okay, so what we're going to do, take these two figures, multiply by, let's show the 2 years as well, 5,1. You're going to get here 511.5 times with 80%. Year 2 is going to be $844. Sorry, not dollar. This is going to be in Megan peso. Is that okay? This is going to be in Megan peso. 844 multiplied by 20%, giving you 409.2, 168.8. Okay, so that's what you got there. Next one is going to be workings number 6. Maybe you want to show TAD. I think TAD is not what we want to find. We want to find actually balancing allowance or balancing charge. Okay, TAD is not an issue, because we're going to have Megan peso. Year 0, your cost of your machine is 1250. Well, the life is 5 years. I always do 4 years for TAD. TAD accumulated 125 multiplied by 4, but in TAD per annum is 125. Okay, TAD per annum is 125, so this is going to be 625. Then you're going to get a book value something like 625, and year 5 you're going to have a sales proceed which is 500. You're going to sit down and cry. Sorry, this is going to be 500. I'm very sorry. This is going to be 500, and this is going to be, forgive me, 750, and you're going to make a balancing allowance which is 250. Doesn't matter what you do, the effect is the same. Okay. All right, I think that's the working we need to put in here. I think that's so much of workings, and you're ready to do appendix 1. Yeah, we're ready to do appendix 1. Okay. All right. So there's a question saying explain the depreciation effect on balancing charge. Okay, that's what I did. Okay, so when there is a depreciation for 4 years, then your balancing charge will be the remainder of the thing. You can also, some of them say, I want to calculate depreciation for year. My teacher say like that. Okay, accounting is different. Yeah, you want to calculate, no problem. 125 times 5, you're going to get here. Yeah, I did that just now actually. 625. Then you go 1250. You're going to get here 625, and you're going to get 500 here. The balancing charge, but charge is when you make a loss. Is that okay? Charge is when you make a gain. Balancing allowance, balancing allowance is when you make a loss. So 125. So this is year 5, and another year 5 there'll be a 125. So actually 125 for year 5 for TAD, another 125 for balancing allowance. Total is actually 250. So it's just wasting your time separating both. Okay, now let's open up a new window for the appendix. Okay, get some lines. Okay, we're going to have appendix 1. Okay. Appendix 1. NPV calculate. Very simple. Just keep it simple. Yeah, don't need to go and say estimation of project NPV. Okay, you can just say NPV before Balut's offer. That's simple. Keep it simple. Okay, then you're going to have lines to draw. Oopsie. Okay, you're going to have lines to draw, and you're going to have 5 years of lines to draw. This is investment appraisal, foreign investment. Most probably you're going to use up the whole thing. Most probably 1, 2, 3, 4, 5. Okay. 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 We're going to have these lines drawn properly. Blue color. 0, 0, 1, 2, 3, 4, 5. Okay. We're going to put this first step, put all in Megan peso millions. Sales, show some working. There's a working. So just put the referencing there. Working, I believe you can put that one there. Okay, let me put the first figure alone. 1209.6. The rest, put it yourself. In exam, leave a line if you want to, but today I want to show all in one page, so I'm just going to put it here. We're going to have production and selling, which is in bracket 511.5. Okay, there you go. Then you got special packaging. All this must be in Megan peso. Remember, project cash flow, project currency. First step, 160.1. Training and development, 409.2. Then you go on, you go on. This one only got 2 years, so I must well do for you. This is 168.8. This is don't have dash for training and development. Now, I like to do this method. I never like to show savings at all. Yeah, it's a bit tricky if you show savings. Trust me. Since this particular year, if you check this suggested answer of the examiner, since exactly I recall this particular question, they have they have changed the approach to take into account TAD as an expenses. Okay, they have changed an approach to take into account TAD as an expenses. But today what they do is that they take that out from the mainframe there, and then they're going to calculate the profits after TAD. They take the tax and they bring back here. But you can always show the TAD here. TAD is not a cash flow, remember. This is actually, you're making a mistake here. You're making a mistake. It's okay. It's better rather than making a mistake in the main answer later on. Because if you don't show this method, especially when the tax losses, okay, tax losses being allowed to set off, okay, in a foreign country, sometimes they have complications like this. They may say the losses can only be set off by the same project. So if you got a loss, you have to carry forward until you find a profit. And this automatically will be the case if you're going to another country, because your losses in another country, you cannot simply pass it back to your home and say, okay, I brought back losses. Well, can't do that. Okay, so be careful. This method, I think, is quite a safe method. So it's going to be 125, 125, 125, 125, and 250. Since I'm going to call this balancing, I'm sharing the line here. You don't have to put BA as a separate column there. You can just share the line. And if you want to argue, I want to calculate TAD, which is 125, go ahead. Inside here got 125, and inside here got BA of 250. Same thing. Okay. Next one, you're going to get the total of this. You're going to get the total. This is the first step, project cash flows before tax. Okay, so we're going to get the tax profits or loss, taxable profits. Profits or losses, you're going to get here 3.8, 500.3, 1425.4. I'm just giving you the full answers here. 73.6, 4065.2. Now you got to calculate your tax. Same year means you pay tax in the same year, which is going to be 25%, isn't it? 25%. You're going to get here 1.0, 125.1, and you're going to get some tax over here. I leave that to you. I leave that to you. Now, once you have done the tax, you are going to ask for forgiveness. Is that okay? You made a mistake. Yeah, you made a mistake. This is a mistake. You should not put this in the cash flows calculations. This is not cash flow, but I purposely put it so that I can get my correct taxable profit. And now my tax is correct. But then I realized this is a mistake. So what do you do? Well, you can always do like this and continue your life. That's not nice to see. So what you do is you ask for forgiveness. Is that okay? How do you ask for forgiveness? You just add back the TAD and PA. So you make a mistake, you ask for forgiveness, you're going to get 1. And that's it. As though you did not bring the TAD at all in the cash flow presentation. It's just like our free cash flows. Remember free cash flows? You put in first, get the correct text, then you just add them back, and there you go. You're finished. Okay, finish. That's it. TAD, you're going to have machines over here. Machines. Now you're ready to put in all your other capital costs. Machines, you're going to get here 1250. Somewhere they're saying you're going to get a scrap of 500, and you got land and building, which is 1250, and somewhere they're telling that you're going to get 80%. That's going to be 1000, and working capital is going to be 200, and you're going to get back your money in full. That's an assumption that you need to make. Okay. All right. Okay. What you're going to do here is you're going to get the totals. Now, this cash flows, Megan peso million. It's going to be 2700,127.8, 500.2, 119.4, 1005.22298. You're going to check it slowly. Yeah, you're going to make a cup of coffee after this and start to try yourself out this question within exam time conditions. You must do it within the appendix, or you should wrap it up in 45 minutes to 1 hour. Maximum 45 minutes to 1 hour. Appendix. There are 2 appendix here. You should have finished that one 45 minutes to 1 hour. Okay, you have that one there, no problem. Then you got the exchange rates. Exchange rates, this is going to be in working number 1. It was given at 72, 76.24, 80.72, and you can go on like that. What we do here, this is our end of the first phase where all your cash flows has been translated back to the home currency from the foreign project. Okay, so what you have to do is when you want to come back home, in this case it is Megan peso per dollar, so we need to divide this particular thing and you're going to come back home. Okay, all this divide, multiply, all this you should know how to do. This is our very basic stuff. Okay, you should know. You cannot afford to make multiplication. You don't go and multiply with this. You should know how that you should divide, because $1 is so many peso. So this is going to be how many dollars, something like that. Is that okay? So this is going to be 37. Well, this is in million. This was in million. When I divide, I'm going to get like very small figure. So I just want to make sure that I want to put all in thousands now. I just want to put 1,000. I think the examiner's answer is putting in millions as well, but the figure looks like so small. So allow me to put in 1,000. This is going to be in bracket 37,500. You're going to get 1676.3. 6196.7, 13969.8, 11107.2, 23991.9. Is that okay? That's the answers you have here. So you're ready. You are at home already now. And then you need to go to the second step. Sorry, this is the second step. Second step is convert to your home. The third step is going to be, which is don't have in this question, which there is we don't have it in this question. There's other questions you can check. The questions like Yilanwe is other questions. But I've seen, I just went through the earlier videos. I've seen the previous presenters have done that question, so that's why I didn't choose that question. In fact, that's the best question to do for practice. Is that okay? Yilanwe, it's a very nice question to practice. But Megan is good for real options included in the foreign investment appraisal. Okay, what you can have here is you can have here United States of America text. Okay, I'm assuming Komura is from United States. If you have, why you have that? Because maybe there you pay 20, you come back, you pay 25, you must pay additional 5. But this is the other way around. There you pay 25, you come back, you pay 20, so no need to pay. In this question, you don't have a USA tax. And another thing that you will have here is that you will have this something called contribution. Let me put it in red color because this question don't have contribution for special component. Contribution for special component. Okay. In this case, it looks like you're giving at cost price, so it's not an issue at all. Now the idea of intercompany profit transfer is this. You see, this is an organization, upstairs, downstairs. Okay. If I buy for how much was the cost just now? Okay, let's say I buy for $100, for example. I buy for $100 and I don't pass it to anyone, so I show $100 and I'm fine, that's my cost. But what if I pass it on to him at $100? So he's going to show $100. Fine, that's it. The whole entity will still have to record $100. One fellow will take the responsibility to record the $100. The problem will start if your cost is 100, but when I pass it to you for 120, so I have made a profit of 20. So you have recorded 120. I have to come back home and show a profit of 20, because end of the day, consolidation, the cost is only 100. That's the idea of this intercompany profits, transfers, whatever. So if there is a profit added to the transfer of goods, then the HQ or the parent company will have to recognize the $20 profit in its home country and have to pay tax on that particular figure in that particular country. Okay, so this is contribution for special component in that matter. And probably you have others like management fees and stuff like that. Well, in this question, it's fine. Nothing is there. So what I have to do is straight away put in the discount factor, relevant, specific WACC, which is going to be 12%. This is going to be 0.893, and so on and so forth. And what you do is you go until the end. Is that okay? You in exam, you go until the end. Then only you stop writing, because every marks, even though it's mistake, you still carry marks everywhere. Okay, 37,500. And let me just give you the last answer. 1496.9, 4938.8, 9946.5, 70.64.2, 13603.4, and you're going to get an NPV of negative 450.2 thousand. This is in dollars thousand, which if you want to put it in a full figure you put as dollars 450,200 dollars. It's going to be a loss. So we are actually okay with the first stage. Just remember, the first stage of investment appraisal will be quote all cash flows in foreign country in foreign currency. Careful, the sales might be in America, change back to Megan peso. The cost might be in America, change back to Megan peso. It rightfully belongs to that country. If the supervisor is going from America to there to work, and he's paid in America on behalf, so you still have to convert the supervisor's salary into Megan peso over here. Just remember, whoever working there, whatever cost that is incurred in that country must be recorded in Megan peso. After pay tax, what you must do? You have to come back home. Is that okay? When you come back home, how do you come back home? Exchange rates will be there waiting for you to welcome you back home. Is that okay? This is going to be your cash flows. Your cash flows back home, what happens? There could be some adjustments like intercompany profit for the components, like that you have loaded some profit into it. Like for example, this one supposed to be 100, but you're charging the float 120. Rightfully, its cost is 100 for the entity. Then you have to show as a profit in your side here. Okay. Everybody clear with the first phase, Appendix 1? Okay. Let's take some questions here. Royalty fees treatment. Okay, maybe I'll give you some example. Can you explain transfer pricing in this situation? I think your name is not there. I just explained transfer pricing situations just now. For this case, there's no transfer pricing situation because everything is at cost. If it's at cost, one fellow takes the cost, then fine. Okay. Royalty fee treatment is the same thing. Now, royalty fee treatment, wait, let me just show you. If it's royalty fees treatment, now royalty fees, you must understand, it doesn't cost the entity or the whole company, parent and subsidiary combined. That's not. It's just that I am charging you for for a purpose. It's to measure divisional performance. That's it. Yeah, it's the purpose of royalty is just to measure divisional performance, or maybe tax. In terms of tax, is tax planning. Let me put it in a nice way. Tax planning, not tax evasion or tax planning. Now, royalty is going to be this. This is your HQ. This is going to be your subsidiary branch. Okay. Now, if you have made a royalty income, if you got a royalty income of, let's say, 100,000 US dollars. So what happens here is he will show a royalty cost of 100,000 US dollar equivalent to that currency. Okay, equivalent to that currency. That's it. So if you got $100, you have to pass it to him, and what he'll do, he will multiply with Megan peso to convert it into Megan peso, and he will show as an expenses, and he will pay tax accordingly. That means to say the 100 will come here, the 100 will come here, the 100 will be inside here, but sitting in what format? Megan peso format. And what will happen to this 100? This 100 will be declared in the holding or parent company as 100, but it will be net of tax, because when you have 100 income, you will have to pay tax in your country. So it's going to be like $80 or whatever coming back. So the idea is I push up at cost price. Let's say, for example, let's make it simple. Okay, let's make it simple. No tax. Okay, both countries no tax, and both have the same cost. Sorry, same currency. For example, they are in the euro block. All of them are euro. So what happens is I'll charge euro 100, and you will show cost euro 100. That's it. This is what's going to happen. You show us your cost, I'll show us my income. Full stop. End of the day, what happened? You show us your cost, I show us my income. Overall, the project is not affected. But when the currency is different, this will change to the particular subsidiary currency. Of course, there's a tax inside there. One of the idea of doing this is to tax planning. Yeah, you do this when your tax is high rates here, tax is low rates here. I don't mind paying tax a little bit here and running away from that side. Okay, all right. Okay, that's the first part here. The next part, we're not going to go to the report. The next part is going to be on Black-Scholes option pricing model. This is clearly the estimation for the, what do you call that? Come. Appendix 2. Appendix 2, we're going to have estimated value, project value to include, very quick one, right, very quick, Balut's offer, option to sell, abandon, whatever you want to call it. Okay. Okay, I think I've answered the tax treatment on royalty just now, right? Tax treatment. Okay, estimated project value to include Balut's offer. Now, just say this is just a quick way. This is an option to abandon. Therefore, we'll be using a put option. Okay, put option. You still have to use put call parity theory, but to do put call parity theory, you need to find the call first. Okay, call option is still needed. There is 5 determinants that you need. Okay, there's the 5 determinants that you need. Usually the marking scheme will be 2 marks for all the 5 determinants, and they might package it which one yeah, will get which marks. From the experience that I get from this particular I mean, looking for students, they don't get it correct usually for the PA. Yeah, just put that PA, RST. These are the 5 determinants. Okay. These are the price determinant. Sorry, the 5 determinants. What is the easiest one to put in is obviously your RF. Now you know why they give you the risk-free rate and stuff like that. Yeah, risk-free rate. Where's that? Last paragraph. They said the treasury bills is RF. Now the reason why you must use RF. This is RF. This is RF. The reason why you must use RF. Anyone can tell me why do we use RF? Why not we use bank KD, for instance? Why don't we use cost of equity? Why don't we use some other discounting purpose? Okay, RF is actually here discounting. It's coming here to discount some fellas there. Okay, waiting for your answer. Why RF? Okay, why? Sorry, not why. Standard deviation, I think that's going to be maybe no marks for that one. Is given straight away 35%. Is that okay? You're going to get your 35%, 35. And the time to expiry is a time where you're going to sell and cash out. So it's going to be 2 years of waiting time. Let's see, there's some questions coming here. Minimum return required by Amartya. Minimum return required. Well, I'm looking for some other answer. I can accept your answer. Minimum return. You can argue and say that this is minimum return. But I'm looking for some other answer. Anyone else can try. Come. We have here PE. PE is going to be exercise price. Okay, PE is going to be your exercise price. No doubt, Black Scholes option came out last exam. June 2018, it came out. Came out in March. I heard it's a theoretical paper, I heard. Yeah. Theoretical. March was a theoretical. In June, it was computational. So Q1, question 1, okay, is similar to what William Parrott have wrote an article on portfolio options, fruit analogy, okay? Will it come out here? Well, I'm not sure, okay? It will come out, it might not come out. That's good to have a go. If it comes out, then you're gonna score, okay? Okay, let's see this, some question. Because we assume option will have minimum risk. Very good. Tanzim, yes, you are correct. There is no risk in option. In life, when you have an option, kind of like you don't have a risk. So that's why you have to use RF. Okay? P is 28, Iman. Yes, you are correct. You do not discount this PE. Let's put all the figures here. Do not discount this. Students will like to discount this, don't know for what reason. Do not discount this. Okay, don't discount this thing at all. And if you see the formula, the PE will be sitting with, the PE will always be sitting with the, what they call E to negative RT. E negative RT is a discount component, discount factor component. Okay, we don't want to go into so detail. Okay, just go to the and just answer and come out from the exam hall. That's it. Don't need to explain so much to the examiner. Okay, just calculate, pop, come out on it. Is that okay? Don't go and explain this is discounting or not. Don't want to explain. No time to explain to the examiner. Yeah, today I can explain, but in exam, do your job, come out, yeah, and wait for results. It'll be a pass, okay? Now, what is PA? Anybody can tell me? Anybody can tell me what is going to be the PA for this question? Okay, I think most of you like got it right. Okay, bond, yeah, bond. Okay. Well, Iman value, sorry, Iman 30.6. Emma, value of the original investment, PA? No, Emma, no. Amartya saying 64, 35.7. Dinesh Agrawal, discounted cash flows. Yeah, which discounted cash flows, Dinesh? Yeah, so 28. Maza Abbas, I'm not sure you're answering which question. 28, are you answering PE or PA? Maza, if you're answering that 28 for PA, I'm not sure you'll be correct. I'm sorry, you know, right? PA will be the discounted cash flows, okay? If so, the value obtained is PA. Or the value obtained is PA. In this case, your value obtained was how much? 28. So what's going to be PE? PE is also 28, isn't it? So, okay, very good. I'll say it's going to be PV, present value for year 3 to year 5. And Alex, I think I got it right just now. Okay, what's the figure? Somebody gave me the right figure. Yeah, Iman gave me the right figure. It's 30.6 million. What is the PA? Just remember, this one is always a difficult thing in the exam. PA simply means after you exercise. Remember these words. I'm stressing these words. After you exercise. After you exercise. Whatever cash flow that is coming in for a call or not coming in for a put. Actually, what are you doing here? You're doing a call option here, actually. Technically, you're doing a call option first before we do a put call parity theory. So the PA will be what cash flows that is going to come in after you exercise. Yeah, after you exercise. Just remember that. Just remember this thing here. It's just like an ice cream. It's just like an ice cream. Let me just give you this ice cream. Okay. This is year 0. This is year 2, whatever. PA will be the ice cream part. This is the best part. Is that okay? After you exercise, discounted. That's the PA for a real option in any question. Students always make mistakes. Out of 100 students, maybe 30 or 40 students don't get the PA correct in exams. Don't know for what reason. Okay? You can't be one of them. Okay? Now, let's come back here. Where's my window? Okay. So this is going to be the sum of all this. After I exercise, it's going to be sum up. Let me just take this figure and snap a picture. And we're going to go down here. The PA will be simply be this figure. Okay, the PA will be this figure plus, sorry, forgive me if I'm doing this. Okay, this is going to be you add to this figure, and you're going to add to this figure, and you're going to get this figure. Okay, so this is going to be let's clean up. Let's do some cleanup. Okay, now that's good. So this is going to be 36,14100. Okay, and that's your PA. Okay, then you have to do D1. D1, I trust you know how to do the formula. You remember the formula. If you can remember the formula, you save technically 2 minutes in exam. No need to write the formula. I think the formula will take flipping the page and coming back. 2 minutes will be gone. So usually I tell the students, memorize all the formulas. LN 3614 100. I'm just doing it approx. I'm doing approx. 28,000,000 plus with 0.04 plus 0.5 multiplied by 0.35 square multiplied by 2 over 0.35 multiplied by 2 root of 2. You're going to get this answer. You're going to get 0.5894. I have my answers here. I use Excel sheet formularized to get all these answers. I never press my calc buttons. Students press the buttons in the class. Okay. Now, this is going to be D2 now. Will be the same thing. D1 0.5894. Just check these answers. If it's wrong, maybe after you let me know. Maybe we just check, double check. Minus your 0.35 multiplied by square root of 2. It's going to give you 0.094. ND1, ND2. Can I trust you know how to do this? ND1, ND2. Which is going to be N 0. Okay, now in exam, if you are using the table, I think most of you will be using the table. Some of them using calculators. Now, if you are going to use the table, make sure that you're going to don't care about the accuracy of that thing. Don't waste your time. Don't waste your time in exam. Just go and write 2 decimals because the table will have Black-Scholes normal distribution table reads from outside to inside. You read from outside to inside. Well, let me get some. Okay. Now. Okay. Okay. Now let's come to the table here. When you have the normal distribution table, you just have to do something here. You just have to make sure you read from outside to inside. That's for Black-Scholes. Value at risk, you read from inside to outside. That's value at risk. In this case, it's going to be 0.2 decimal is fine because you only have 2 decimal. 0.44. That's it. Okay, so in this case, it's going to be 0.59. You're going to get positive figures. It's going to be always you take 50%. Yeah, you know all these things. Okay, at this level, you should know already. Okay, we're not here to teach you how to read the tables. Simple. Plus 0.5 if it's more than 0. Less subtract from the 0.5, not minus. Take and minus 0.5. From the 0.5. You must minus a few items there. Okay, this is going to be, if you see the table, it should be 0.5 plus 0.2224, and it's going to give you 72.24%. So this is going to be ND2. I'll leave that to you. Is that okay? ND2 will be, sorry, this was 94. So it's going to be 0.2 decimal means 999, correct? 09, correct? 09, and your answer must be 0.5359. And you're going to put in the call value. You're going to put in the call value, which is going to be 3614. Well, you're going to open up the zeros. Go ahead. Multiply by 0.7224 minus 28,000 multiplied by 0.5359. Sorry, no space here. Multiply by E negative 0.04 RF multiplied by 2, and you should get the answer. Is that okay? You should get the answer something like 82,64080. Okay. Well, this is not a call value. This is a put value. Put value is going to be simply put call parity theory, C minus of PA plus PE, E negative RT. See, whenever you see a P, there's a discounting that's going to happen. Whenever you see a PE, there's a discounting that's happening here. Actually, we're discounting the exercise price to present value using continuous discounting. All right. So this is going to be, well, I think you can put in all the figures there. This will be equals to 34.97, 34.97,238. So overall of the project, overall NPV will be equals to, this is a price, this is put option and option to expand. You do this method. You take your original NPV, you plus with the option value, which is negative earlier, okay? And you're going to have real option value, which is 34.97,238. Forgive me, my calculation, maybe there'll be differences because probably I am using the formula sheet, the Excel sheet to calculate, okay? There could be some differences there, but not to worry, it's about there, okay? 3047,038, you're going to get NPV positive there. Overall is good, okay? That's it. Okay, we'll take a short 10 minutes off, okay, 10 minutes break, go and have a drink, and we'll catch up with you in about 10 minutes from now. All right, keep your questions coming. I'll answer questions before I start the report writing. Okay, see you there. Okay, hi, you guys still there? Can you hear me now? Can you hear me? Just say something so that we can start talking. Okay, let me just answer some questions. The previous questions. Okay. Alex is asking, could you please remind on pour or call option, how to identify them in the situation? Now, there is only one put option that is going to be examined. There's only one scenario for put. That is, you are going to receive money upon exercising. Okay, upon exercising, you're going to receive money. Put defines as option to sell. Call is option to buy, or in other words, pay. So if you're going to pay, that means it's going to be a call option. And if it's going to be a receiving money, it's going to be a put option. Okay, Alexei? Amartya is asking, can you explain the PA once more? Okay, all right, once more. Well, let's do it. PA is like this. This is your timeline. This is your exercise date. Any cash flows that's coming in here, you get the present value for that one, and that's going to be simply your PA. If you're going to sell or if you're going to buy, for that matter, it doesn't matter what you have to do. My screen is stuck. Is it okay now? Can you all see me writing? Can you guys see me? Am I writing? Can? Yes, okay. All right, sure. I think it's all okay now. Now it's moving again. Okay, sorry about that. Something wrong. Okay, maybe I took a too long break. Okay, now coming back to this identifying this particular PA is going to be whatever present value that you're going to come from here. That's going to be your PA. That's it. That's simple as it is. Okay, I hope you understand. Maybe after this, I plan for one more question on option. That's a tough one. I'll show you how to get the PA there as well. Okay, good. All right, nice trees. Okay, no connection to the trees. Okay, coming back here. Report writing. Let's minimize this. Okay, report writing. How do you write a report? As I said yesterday, those of you who were not here yesterday, you can always listen to the recordings. Well, you're going to have the word report. You're going to have to, from. You're going to have date. You're going to have regarding or subject matter. You're going to have investment appraisal, maybe of a project in Megam. Okay, Megam, underline. You get 1 mark for this. You already got 1 mark for appendix. Okay, you already got 1 mark for appendix. Okay, what are you going to do? After that, you're going to have one introduction paragraph. You're going to have an introduction paragraph. In this introduction paragraph, you're going to say the purpose of this report, okay, is to investigate the investment in Megan. I'm just writing like not full structured sentences. Investment in Megan. Okay, without, and with considering what? Without and with considering the option to sell to Balut. Okay, so that's one paragraph. You have your what do you call this, introduction paragraph, together with, then you're going to say together with, sorry, together with the risk Okay, risk on foreign investments. Okay, foreign investments and all assumptions made. This is introduction paragraph. Is that okay? This is going to be intro paragraph you have to write. Now then you're going to have to bring, I mean professionally, you have to bring what you have calculated. You have to bring. It's good to bring, but sometimes now there's no marks for bringing that one inside. But I would just very quickly in the first paragraph, I'm going to say purely on financial ground, okay? Purely on financial ground without opportunity to exit. The NPV was how much? Negative $450, $200. It is from Appendix 1. However, with rail option, I'm just scribbling very fast because I want to do another question. However, with the rail option to sell to Balut, let's put B for Balut, the project has a rail option value. The project has a rail option value of, how much was it? 3.4 or something like that. 3.4, 3.5, around 3.5, okay? Of 3.5 million. Or should I say 3.5 million, something like that, okay? 3.5 million. Overall, together with this, overall giving you 3.05 million, okay? 3.05 million. Okay, that's it. Next, this is introduction plus some conclusion. I mean, we bring in some of our conclusion down here. Then we are going to go on to assumptions. Get a line, some lines there, okay. Assumptions. Now these assumptions, you must know that there are two assumptions grouping here. The first assumptions grouping is going to be on what do you call this? Investment appraisal. Okay, so we're going to have assumptions on investment appraisals. There are a lot of questions on investment appraisals assumptions. You can just take any of the investment appraisal questions. There will be assumptions down there. 3 to 5 assumptions if you want to throw it in. Okay, we're going to say the forecasting is accurate. Okay, forecasting of your cash flows are accurate. Then you move on to say probably you want to test for accuracy. Is that okay? Test for accuracy. We will do what do we normally do to test for accuracy, guys? Come on, just mention something. And the second assumption in this particular case, you can say the cost of capital. Cost of capital, maybe you say reflects the risk in foreign country, and it's correct. Yeah, test for, very good, Emma, sensitivity analysis. Okay, test for accuracy, maybe you do something called sensitivity analysis. Okay, sensitivity analysis. Very good. Okay, Mazal. Now, cost of capital reflects the risk. We're going to talk about general assumptions on working capital will be recovered in full. Full sentences, okay? Make sure it's full sentences. I would write many assumptions here because I know all this. Before you go into, let me tell you again one more time. Let me tell you one more time again. These assumptions you must remember. Assumptions, just write in a piece of paper and memorize them before your exams. Okay, assumptions on investment appraisal. That includes foreign investment appraisal. So here we're bringing investment appraisal plus foreign investment appraisal. Assumptions on rail options. Assumptions on business valuations. These are the three common assumptions that your examiner likes to ask. Well, if there's an assumption is going to be there, at least 5 marks is yours. Plus the 4 professional marks, you already got 9 marks already. You just need 41 marks to pass this paper. Yeah. Now coming back here. Sorry, it's no more 10 minutes. Okay, oopsie. Okay. So working capital is recovered in full. Maybe we'll go on to some foreign investment appraisal. What are the foreign investment appraisal assumptions we're going to say? PPPT holds. Okay, purchasing power parity theory is the best method to approximate forecasted exchange rate. PPPT holds. Okay, for forecasting. Forex, foreign exchange rates. Okay, very good. Now, well, what else you can say? Well, we're going to say the tax, there will be no tax, no dollar tax, money remitted back home. Remember in this question, you pay there 25%, American got 20%. By that, when you come back home, you shouldn't be taxed. But sometimes some governments will base on the money that you bring back. So we just assume that there won't be any tax on, that means the tax is purely on earnings in that country. If you pay it there, here you come back, no need to pay. So we're just going to make sure that no money, tax on remittance back of the money. What else you're going to say here is, what other assumptions? In this particular question, we know that the special packaging, I bought at a cost of, let's say 100, and I gave it to you for 100. Now the government of America will be upset with this deal because you are selling something to another country at cost price. They might not agree, so the government might not like it. Some governments don't like you sell to other countries at cost price, even though here you are not. In fact, 25% you should sell for higher price by right if you want to play with tax planning, but you are giving at cost price. Anyway, government of America will not like it. Okay, will not like it. Where's my writing? Okay. Number 6. Number 6, we assume that the home government will not impose. The home government will not impose any conditions on export, okay, of special packaging at cost price. At cost price. Usually they will want to request at what length? What length transaction is that? What length? Arm's length. Very good. Arm's length transaction. Is that okay? Arm's length transaction. So these are the assumptions that I would write. I got 6 assumptions here. Of course, you can build up. You go and see all other questions like for Buki, TISA. What other questions you have? Yilanwei, I'm sure there's some assumptions and all that. Yeah, Yilanwei, or Yilanwei. I'm not sure how to pronounce that. All these investment appraisal questions has got some assumptions there. Just go and read up that one. Now, then we're going to have assumptions for rail options. Assumptions for rail options. You just remember this in terms of your determinants. In terms of R, we say it's going to be constant. It's going to be constant. Treasury bills, it's going to be constant. In terms of S, you say it is known and it's going to be constant. Okay, it's not easy to know. Knowing is one thing, and then making it constant is another thing. It's like 2 hurdles there, you know. So that's going to be assumptions or limitations. Okay, RS. What else we have? We're going to talk about PA. PA, we assume that the project will be traded, assumes that it's traded and has got price. Is that okay? Assume that the projects are traded and has got price movements. Only shares are traded, but Black-Scholes assumes that projects are traded and has got share price movements. Then only you can do this particular calculation. Okay. PE, nothing, no assumptions for PE. We'll talk about that one for put options one later. PE, one more is what was that? SRST. T is for time. Time, you assume that this is a European model. That means Balut would only offer, would only offer to buy, or you sell to Balut at exactly end of year 2. End of year 2. And not any time earlier. Okay, and not any time earlier. Okay, so this is what you have: 5 determinants, 4 assumptions. For put options, you can say in terms of PE, Balut would honor its words. Is that okay? Only for put option you can mention this. Balut will buy from you end of year 2. Today, anybody can become a hero by saying, you start first. After 2 years, if you can't, pass it to me. Big brother will take over. But after 2 years, big brother will run away sometimes. Is that okay? They will be thinking, oh my goodness, I think I can't sustain this, because sometimes things will be clearer after 2 years and you might take a moonwalk. Is that okay? You might take a back walk and you might not come in. So Balut will honor its words. Okay, that is the assumptions. You guys okay with the assumptions? Yeah, you should get 3 marks, maybe 7 marks for assumptions for this one. Now, then you're going to go talk about other business risk. Now, risk in P4, there are many questions. Yeah, examiner always asks, what are the risks imposed here? These are going to be additional business risk. Okay, additional business risk. Many paragraphs, full structured sentences. 1 paragraph, 2 to 3 words there. It's good enough. Sorry, 2 to 3 lines of words. Okay, sentences, not words, sentences. 2 or 3 sentences, not 2 or 3 words. Okay. First point here, we'd like to say, okay, put number 1, number 2, no problem. We're going to talk about political risk. Political risk is what we're going to have here. We're going to say government may be unstable. Unstable government, maybe. Yeah. A lot of countries, yeah, after election becomes unstable. New government, yeah, political risk you can add on by saying new government may come in and may increase the tax further, may impose restrictions in remittance, okay. These are the risks that you're going to see specifically for political risk. Country megam's infrastructure, will they have railway building? Yeah, railway. Will they have roads? Will they have roads, shipping? All this, sometimes you make sure that you have before you go there. All these are risks. Risk in the sense that Kimura will want to ensure can export special packaging, can export special packaging without restriction. Well, the first paragraph, first part A, they said this is going to be under what? They're going to lift the ban. Okay, they're going to have more of the free trade. So I think this shouldn't be a problem. But what if they don't change that? Next, we want to have, what if the risk? Another risk is that what if they reimpose protectionists in the future, like what our president in America is trying to do today. Barack Obama wanted to move towards free trade. Our friend comes and says, okay, we're going to go back. Let's make America, yeah, better. Yeah, we don't take advantage of it. So he wants to put protections. What if the government is like that? Yeah, that's going to be a risk out there. Okay. Risk is going to be bilateral agreement for tax must be in the long-term basis, must be continuing, or else your tax bill will go up, because when you come back, you're going to pay tax. If let's say there's a political problem, you pay there 25%, you come back, you don't need to pay, because there's an agreement. If there's no agreement, you come back, you pay another 20, total 45. You're working for both the governments. Is that okay? So make sure there's always an agreement and they don't go into fighting or war or whatever, either trade war or physical war. What other risks you're going to have here is going to be, we said just now, remember, it's a food and safety regulation risk. Make sure you comply with their food standards. Employment law. Employment law risk, okay, don't take advantage of the laborers there. They are cheap. Yeah, they are cheap. They are hardworking, they are skilled, but don't exploit by paying bare minimum wage. Minimum wages is good, but don't exploit that position as well sometimes. Okay. Cultural risk. if you're going to a country where you got to make sure your food is in line with their culture. I'm not sure what they're doing. If it's going to be non-halal, then make sure you're going to be halal type of products. You got to do it. Yeah, cultural risk. Maybe you're going to say also the risk of minimum standards set in that country. There could be some minimum standards of food, whatever, in the country, or maybe in terms of other countries as well. Quality standards important. Quality standards, all these are risks. Put them into one paragraph. Okay, ensure up to mark. All right, because usually production abroad may compromise may compromise quality. Well, you can say operational errors, all this risk. There are a few questions, you can go and check. Talk about risk only. Like, well, this is one of them. Then you can check, I think it's Kleinek or something like that. K-I-L-E-N-C, Kleinek. Okay, all these are talking about risk in going abroad. So get ready. If the question is going to be about foreign investment, this type of things they like to ask, examiner likes to ask. Okay, read up the theories on the foreign investment appraisals. Theories on foreign investment appraisals, like barriers to trade, free trade. Okay. All right. So that's what you have there. Then you're going to have the recommendation and conclusion. Recommendation and conclusion. You just quickly say like you may want to say, overall this project is not viable, but with the options attached to this project, it turns out to be looking good now. But however, we also need to take into account risk and all that. So I'm just giving you a pointer here. Okay, I'm just going to say my first sentences will be overall not viable, overall not viable, overall, but taking into account put option makes the project looks good. But however, also need to consider what? Consider risk as discussed above, attitude of the investors. Is that okay? Whether the risk this first can take or not, and you just finish off by signing off. Is that okay? This is going to be the 50-mark style type of question. And foreign investment appraisal. There are a few questions here. This is one of them. Go and do Yilanwe. Go and do Yilanwe. Please do Yilanwe. Yeah. Investment appraisal, I think for some time it has been missing out from the exam. I think the last it came out was September 17 or something like that, if I'm not mistaken. Just in case, yeah, better do Yilanwe. Yilanwe got some royalties inside there, etc. Transfer pricing, law, and all that inside there. But I think our previous presenter have done a good job. The answers there, so you just have to look for the previous videos for this one. So I didn't want to do it. I wanted to do this, but then they have done it. So I think you might as well do a new question with you guys. Okay. So this is what you have here for this particular foreign investment appraisal. Since we are in the real option, we are going into one question called Furlion. Where's that? What page is that? Furlion. Furlion, I think. Furlion. Yeah, this one. Furlion. Let's take some questions first. Cultural risk upside. Okay, very good. Is that in June 2018? I didn't get you, Emma. What was it for June 2018? Okay. Furlion, I can't remember when they reviewed that Yilan Way. You just go and check the previous videos. They have, I think, March or June, I'm not sure. I just went through. I just want to see I don't repeat some questions. Yeah. So I just went through their videos and I just checked. So there are a lot of past year questions. If you ask me, you can just rely on these videos and just go for exams. All the videos compiled together, I think you are ready for exams. Yeah. Okay. Falion, let's do part A. 25 minutes on the clock. Okay. Assess showing all relevant calculations whether Falion would or should proceed with the significant opportunity. They have got an opportunity. Usually it's an opportunity to expand. Okay? Opportunity to abandon was a put option. Opportunity to expand is going to be a call option. See here again, always they ask you, these are all bonus marks that you should not let go. 5 marks maybe, 4 to 5 marks. Discuss the assumptions mix. Okay, that's number 1. And other factors which will affect the decision before you go to the plant in Naswa. Again, this is a little bit on foreign country. I think they're going to the foreign country. So if you are going to another country, what other factors you need to look for? I think we have discussed that just now, isn't it? Earlier. The Black-Scholes model may be used. All right, the Black-Scholes model may be used. What other options you have? Is that okay? What other options you have? Only that only we learn. Is that okay? The American models are we're not in. It's not in your syllabus in terms of computational, but you need to know the principle behind it that you can exercise American options at any time you want. All right, 16 marks here. Let's do part A. Is that okay? Let's just do part A. Part B and part C, you can figure out yourself. Nothing much there. Okay. Now, Furlion manufactures heavy agricultural equipment and machinery which can be used in difficult farming conditions. Furlion chief executive has been investigating a significant opportunity in the country called Naswa, where Furlion has not previously sold any product. So this is an opportunity. You've never been there, it's an add-on bonus to you. Okay, the government of Naswa has been undertaking a major land reclamation program, and Furlion's equipment is suitable for use for the reclaimed land. This is what's happening in most countries nowadays. They're losing the land and they claim back the sea. They claim the sea and they convert it to land. Okay? Because of the cost and other problems involved in transporting the products, Furlion chief executive proposes the Furlion should establish a plant in Naswa, and he knows Naswa government is keen to encourage development of sustainable business within the country. Okay, because Furlion is in a sustainable type of business, yes, they can do it well. Okay, initial calculations suggest that the proposed investment in Naswa would have a NPV of negative 1.01 million, the NPV. Okay, initial they've thought about it. However, Furlion chief executive believes there will be opportunities for greater flow in the future if Naswan government expands the land reclamation program. It can be negative, like what we did just now for Balut's offer, it was negative. Then you got a positive to add on This is what you do for option to abandon and option to expand. Like in this case, you take your original phase 1, then you add in the phase 2 inside there. Phase 1 and phase 2. Yeah? Okay. The government is at present struggling to fund expansion. That's the risk there. If you go in and the government don't expand, you are dead. Okay, that's the risk there. The government, so what's the best thing to do? You don't go in now. You take the option to go in. Once the government expand, then you exercise your option to invest in that country. The government is at present struggling to expand the program and is looking for other funding. If the Naswan government obtains this funding, the chief executive has forecast that the increased demand product would justify the 15 million additional expenses that you are going to spend in 3 years' time, and the expected NPV will be for the expansion is going to be 0. Okay. Expected expansion for the NPV is equals to 0. It can be assumed that all the costs and revenue include inflation. The relevant cost of capital is 12%, assuming it's fair. Risk-free rate is going to be for your Black-Scholes model. Everything is no risk in Black-Scholes. CE has estimated the volatility of your cash flows to standard deviation is going to be your S. Okay. Careful, huh? This risk-free must be in per annum. It has to be in per annum. Your time must be in years. If they say 6 months, then you must put 0.5 years. Is that okay? It must be in years. Your rate must be in per annum, not per month or per 6 months or whatever, okay? Now, one of the Furlion's non-executive directors has read about the past changes in interest rates and wonders how this might affect the investment appraisal. Okay, we're going to discuss how is it going to be. Now, let me just clear this one. Get rid of all this. No more. All right. Okay. Furlion. Part A, we're going to say valuation. Yeah, we're going to say valuation of option. This is further expand. Therefore, it's a call option. Is that okay? It's a call option. Okay. Now, the 5 determinants. I'm going to need your help now. The 5 determinants will be your PA, PE, RST. Anyone can help me out with any of these 5 first? Which one is the easiest one? PE, PE, RST. What would you like to tell me? Which one I should put first? The easiest one. Let's see, we got some questions coming up here. PE 15. PE 15. Great. Iman will take your answer as 15 million. That is what you're going to pay. Do we have to discount this, people? PE, do we need to discount this PE? And let me just write. No, very good. No, you don't discount this PE. Yeah, don't discount this PE. There's one question called Nante. You're going to check it out. I think most students would have discounted that PE because the examiner gave you a discounted PE as well. So better be careful. Okay, yeah, let's take the thing. We're going to have 4%. Steffi RF is 4%. Very good. 4%, you can write 0.04 to be safe. Okay, 0.04. And your PA, Amartya is getting 10.68. Anyone else getting different PA from Amartya? I hope I got your name pronounced right. 10.68. What about your S here? I think that's our easy ones. Let me fill up the easy ones for you. T will be in time to exercise. That is time to pay this 15 million. That's how you determine your time and your PE, which in this case is going to be 3 years. Okay, anyone else? What other PA that you got? What other PA that you got? What is the PA? Amartya got 10.6. Any other PA answer down here? No one answering. Not sure. Not sure. Okay. How do you get PA? Now, this PA is tricky. What did I tell you just now? PA is simply that ice cream. Sorry, it's not ice cream. Okay, the square ice cream. Okay. This is your PA. What comes in after that for a call? What's not coming in after that for a put? Okay. Zero. Alexi is saying 0 is your PA. Okay. 15 million. Emma's saying something like that. Okay, let's see slowly. Okay, it's okay, no problem. Now, this is going to be exercise in year 3. Okay, what comes in after year 3? That's going to be your PA. In this question, the examiner is very, very tricky here. Very tricky. Yeah. Okay. The negative NPV, this is initial suggestions suggest that it's a negative NPV of 1.01. That is phase 1. That is phase 1. You're going to have a negative NPV and then you're going to expand. Okay. If you start now, you're going to get this. Okay, that's good. But what's happening is that they are thinking in 3 years' time, they're going to spend 15 million. And when they spend 15 million, the NPV for this expansion is going to be 0. So simply moving forward, year 3, they're going to spend 15 million. So let me just put it here. Year 3, they're going to spend 15 million. And year 4 to don't know whatever year they didn't tell us, etc. There's going to be some cash flows coming in here, cash flows coming in here, cash flows coming in here. The PA is simply the present value of these cash flows, full stop. That's the answer. And they are telling you these are the cash flows that's going to come in. So after you exercise at 15 million, okay, what cash flows coming in after that is going to be your PA. But the CEO or CEO, whoever that calculated this one, the expected net present value for this expansion is 0, which means to say this is 0. they have calculated the NPV for this expansion, and this is not discounted at 1. This is discounted at multiplied by your discount factor. You must use discount factor for all these particular cash flows. In this case, it's 12%. So this is going to be multiplied by discount factor of 12% is 0.712, and you got a negative 10.68 negative. And since they say the NPV is 0, and I told you this is going to be the cash flows that after comes in. I don't know how many years cash flows are there. I also put etc. here. So this is going to be discounted, and you're going to get this. This is actually your PA, not this. But because this is 0, it has to be 10.68. All of you clear with the PA? Ken? All of you clear with the PA, or you want some explanation? Okay, everybody is fine. Why didn't we use NPV? What NPV, Ira? Yeah, PA is not NPV. Okay, the first phase is 1.01. Remember 1.01? That's your NPV for the first phase. You put your step foot like this. Let me give you some. Let me show you. Now, let's show you something. Okay. Now, this is going to be a river. Yeah, this is going to be a river. And you have your dad here with your mom, and all the children's there. Okay. This river suspected to have crocodile. Okay, let's say, for example, this river suspected to have crocodile. Now, there may be crocodile, but there may not be crocodile. So what's going to happen is, would you spend all your resources? Would you spend all your resources to go inside the river and not come back? It's dangerous, isn't it? So what happened was the dad goes in first. Okay, the dad goes in first and puts his leg to the water first. Okay, he put one leg to the water, and if his legs disappear, what he does is he comes back. Okay, he comes back. Sorry. Yeah, let me just draw something. Okay, he comes back. Where's his head? Okay. Oh my goodness. Okay, okay, now I draw for him a head. Okay, this head, give it to the crocodile. All right, no problem. He comes back if his legs is going to be missing, and he tells the whole family, let's go back. Oops, bring back the body here. Okay, tell the family, let's go back. We don't want to go and invest. So this is called the first phase. After 3 years, things will be clear. If it's clear, if the government gets the contract, you bring the whole family there. Is that okay? So story is like this. Story is like this. You go in there, and let me try again. Okay, let me try again. Yeah. Your father go in there, put the leg and die. Okay, come back and better go back. If let's say the father goes in and there's no crocodile there, what happens? There's no crocodile in the river. This is the first phase. That is the NPV of 1.1 million. 1.1 million. The second phase, what happens is, okay, everybody can go in. Once the first phase, one thing is very clear, everything can go in, and you can go into the river and start swimming. So what you're talking here is this 1.01 is just the first phase. First phase is not used at all when you're doing an option calculation. What is used is, in this case, is we need a PA. PA is the second phase. What's the cash flows that's going to come in after you make an investment for a call, or after you receive the proceeds for the put? The cash flows that is coming in for a call, or the cash flows that's not coming in for a call, is simply the PA. Okay, I think it's clear. Okay, now moving on, we have 6 more minutes. Okay, let's very quickly, we're going to just do some calculations. Okay, this PA is tricky. This PA, you all okay with PA, I suppose now? Okay, good. Now, what you have here is going to be all the determinants that you took here. That's my answer. Okay, this window, I think. Okay, so your PA was like what Amit Paul was saying. It's going to be 10.68. Of course, you got to show workings. They might give you simply 1 mark for this, and they might give you 1 mark for all of this put together. Any of this wrong, you lose 1 mark. If this is wrong, you lose 1 mark. But don't worry, even if your marks are not here, you will still get the follow-through marks. Yeah, follow-through marks in D1. D1, you just use back the formula. You just use back this formula that we did earlier. You should get -1630. You're going to get 2 marks if you calculate this, even though your PA was wrong. But if your mechanics, if your calculation is correctly calculated, you will get the 2 marks. D2, it's going to be -0.6826. And D1, you're going to get to, now careful, if it's negative, and if you are referring to the table, then you have to kind of take away whatever you got from the 0.5. Is that okay? From the 0.5. Okay. So this is what you got here. You will get, okay, if you're using the table, you should be 0.4364. Most of you will be using the table. If you know how to use the calculators, will be good. Yeah, but you must have the right calculator. Okay, 2474, and you're going to get the C value here. The C value here is going to be calculate at 1.36. So what are you going to do? Now you must take the overall strategic value, which is going to be -1.01. This one is your dad. Your dad went and put your leg first, missing the fingers or whatever. Then the whole family went and tried to second phase. Then you press 1.36, giving you a positive 0.35. The revised NPV turned out to be strategic NPV. This is called strategic NPV. Overall, then you come to a conclusion for this. You calculate. Even though this is wrong, you still get marks for this. And you come to a conclusion, you still get marked for conclusion. Seriously, if option is coming up, the most marks you're going to lose is the PA or the 5 determinants. Then you follow through slowly, make sure your calculations are all correct. You might get marks here and there, and you might not lose all the marks. Is that okay? All right, so you're going to conclusion, you're going to say on financial ground, no good if you talk about first phase only. But if you talk about the second phase, overall, it turned out to be good. Is that okay? Sorry, I'm just writing it like that. Okay, so this is going to be a good option. Okay, plus you may also have other values inside. Maybe you also have option to delay sometimes. So there could be an added value now also. There also could be an option to abandon, maybe a government willing to take over from you after maybe the 4th year or the 5th year. Okay, so if there is the case, then you can add on some more to this project. Is that okay? Then you have to talk about the assumptions that we spoke about just now in the question called MEGAM. These assumptions is specifically for real option. You talk about price of the asset is assumed to be traded. Volatility is known. That's a difficult thing. Plus, it's going to be constant. That's another difficult thing. interest rate is going to be constant for the next 3 years. That's going to be a difficult thing for the government to keep up. Is that okay? Then you're going to talk about the time. The time is that, well, this is a European model. European model means that you can only exercise at the end of that 3rd year, in this case. Yeah, you cannot exercise any time earlier. If you were to exercise any time earlier, just mention in the exam answer script that you may want to use the American model instead. Just mention will do. No need to calculate. It's not in your syllabus, the computational part. Okay, then you're going to say asset prices are assumed to be traded. Only share prices are traded. Real options are actually not traded. These are the assumptions. We assume it's going to be traded. We assume that its price behaves on a log normal distribution. We assume that what else? We have a perfect market condition where there's no tax, costs nothing to get information, no transactions cost, but we live in a perfect market. Yep, we got a signal already. Okay, one more minute, Kishore, thank you. Okay, other factors, yeah, other factors we're going to have here, other factors. What is the other factors? We're going to talk about general factors, risk, maybe funding, maybe we talk about tax concession, maybe there's available, maybe there's employee availability. Do you have any employee availability? What is the reaction of the competitors? All these things you have to talk. Of course, you want to be the first. You want to be the leader first. Is that okay? Yeah, everybody remembers the first person who does it. Correct? No? So you must be the first to move in. Maybe you can talk about expectation, government support, all this risk, all these things. You just bluff your way through. I think you should get the full marks for this question. Is that okay? I think time is up. Okay, what we're going to do tomorrow is going to be where we're going to do risk management. I'll do one currency risk management, one interest rate risk management. We'll explain very detailed, okay, for you guys to understand. If it comes out, then it's going to be good. Okay, signing off. Thank you for attending today's session. I'll see you tomorrow. Tomorrow timing, make sure you get the right timing because I think we're starting off a little bit early. Okay, just get the timing from your time tables. Okay, thank you. Good night, everybody. Take care.